Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review. Interest rates rise. Well, everyone came into 2026 expecting more rate cuts, especially if President Trump got his pick for chairman of the Federal Reserve. Well, Trump got what he wanted. Kevin Warsh has now been confirmed as head of the Fed. But the market doesn't seem to think any rate cuts are coming. In fact, market pricing now has a rate hike as more likely than a cut by the end of this year. Inflationary pressures are to blame, which is driven at least in part, if not in large part, by the persistence of higher oil prices due to the Iran conflict and the continued closure of the Strait of Hormuz. The rate on the 10-year Treasury has jumped from 4.25% to over 4.6% in just the past month, which has started to put some downward pressure on stock valuations and caused some near-term volatility in the equity market. Earnings trends still look attractive for the moment, but that could start to weaken if the status quo persists, or certainly if it gets any worse. For this week's featured insight, don't underestimate brand equity. Traditional financial analysis and investment analysis focuses a lot on dissecting balance sheets and income statements. And for good reason. It's important to know what a company's return on assets or return on equity is. Over the past 20 to 25 years, we've seen a fairly persistent increase in price-to-book ratios. One of the reasons for this could be the value of brand equity, which accrues fairly significantly to iconic brands like Coca-Cola, Starbucks, and McDonald's. Actually, assigning a brand value is a little bit tricky, but financial professionals are increasingly working on making it part of their overall analysis when it comes to making investment decisions. Looking ahead, economic data ahead of June. It's a holiday-shortened week next week, but there will be plenty of data for investors to parse through. Consumer confidence numbers will be reported on Tuesday, and recent numbers in this department have been downright awful. And Walmart's lackluster earnings report highlights some of the softness in consumer spending, especially at the lower end of the income spectrum. Durable goods orders and new home sales will be reported on Thursday. And then Friday will include a deluge of data, including second revisions to the first quarter GDP numbers, as well as personal income and spending, and some new inflation data. Now that earnings season is essentially in the rearview mirror, it will be the high-frequency economic data that drives the market for the next 4 to 6 weeks. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.